Good morning, ladies and gentlemen. I hope you all had a wonderful weekend. I certainly did. Let's have a look at what we can expect for the rest of this week. Holiday shortened naturally, as today is President's Day. And we'll start with the same chart as we started last week, and that is a weekly chart of volatility. Well, who would have thought that volatility would end up right at our most important level, which is 1950? Well, funnily enough, I did, and that's why we stayed long 90% of last week before taking profits. It is more than likely that we shall have an inside week again this week. The week after OPEX is invariably a down week, but not by much, by about 1.5 to 2% max, which should take us back at some stage towards 2700 or just below. Now, if we look at volatility events, we will find that almost invariably they come in pairs. Whether the pair comes later or sooner, it is not that important, but I would argue that the nearest that we can match this current period to would be late 15 to early 16. And there we had the typical behavior, which seems to be about 10 weeks of retracement of the volatility move before another volatility move takes place. And that would actually match quite nicely with the seasonality at the moment, because if we project 10 weeks forward, we get to May, and this being the strongest part of the year, the one with the most seasonal buying, while May starts the weakest part of the year going into summer, that would match very nicely. So what we would have thought is most likely to happen is that we have a ratchet down in volatility over the course of the next 10 weeks, followed by another episode of volatility, much like in late 15, early 16. This is an enlarged chart of the monthly SPX. If we try to match those expectations for volatility, we will find that basically what they're telling us is that we will trade from just around below 2700, so 2680, maybe 2670, all the way back up to maybe 2810. Would not be surprised by a couple of months of price action between the 5 EMA in the monthlies and the top Bollinger Band. So basically 2 months or so of making everyone tear their hair out. Don't forget that what has happened in the past couple of weeks is that everyone has been gotten out of their short volatility trades, and everyone actually has bought protection on the downside. So it is unlikely for the market to go straight down simply because everyone has now bought protection. So what is more likely than not is that we spend a couple of months completely taking out the protection that people have taken. Their put options are going to become almost worthless and expire, and after that we can have a second volatility attempt where we break the 5 EMA and go and test back down towards the 2500. It is likely that we will break that 2500 at some stage, but not by much, just enough to get people short, and then we bounce again. So it's going to be several months of very nasty trading with 2820 as the top side, initially with just below 2700 as the downside, and later just below 2500 as the downside, before we bounce back again. That is what is most likely to happen for the reasons I've just shown you. If we shorten the time frame to a weekly one, well, the most likely thing to happen is that we hug this trend line above it and below it, above it and below it for at least 8 to 10 weeks before making the final swoon down and then probably back up. So we are going to have a good couple of months of backing and filling, maybe up to 2800, maybe just above it to 2840, fill all those gaps and then swoon back down. It is now a market which is protected, so we think the downside below 2600 is incredibly unlikely to happen. We have very good support around 2640 to 2620 as a result of all the trading that we've done over the past few days and weeks. We would have thought that's very much the downside. The upside is just 2800 or just slightly higher. We are unlikely to move away from this trend line by very much for several weeks, just as we did here in this part of the uptrend, when we just held and then finally broke down. The most worrying chart for equities in general is actually the European markets, which have managed to turn ever so slightly the 200-day moving average. This mauve line is the 200-day moving average. It is now turning down, but not by very much, so we would argue that it'll be tested on the upside several times. So as the S&Ps go up towards 2800, the DAX will rally to the 200-day moving average. It is now firmly back within the uptrend channel. It has failed to make any headway higher than this channel. So up to towards 12,700, that is about the size we can see it, with multiple bouts of weakness that would go to the 0.38, which is of the whole entire move up in the DAX, which is around 11,700. So 11,700 is going to be an excellent level to buy the DAX for moves back up to 12,700. So what we're saying is we are in a 1,000-point range in the DAX, but that is a warning that the next big move is likely to be on the downside, probably down towards the 10,500 area, which is so important and pivotal in the DAX, and that would coincide with the next big wave down in the S&Ps, sometimes in May or slightly later. As we've been warning for months, this explosion of volatility in the 10-year note caused that nasty bout of stop losses and volatility carnage in the stock market. It is not enough per se to stop the bull market in equities, but it's certainly enough to make people puke up all their holdings. So what is likely to happen in the bonds? More likely than not is that we're going to have a trading range between 3 and 260 for the next several months, and then finally another leg higher. That to us is the most likely outcome. We are now sellers of volatility in the bonds. We think we have a certain couple of months of window in which this market is not going to do too much, and actually is going to whip both longs and shorts out of their positions before the market does another leg higher. This chart is a weekly one of Euro USD, and it actually matches very well with our expectations for both bonds and equities. What is going to make European equities go down so much more than US equities at some stage? Well, it has to be the dollar. It can't be anything else very much. The European Union itself is should be in a period of more stable political situation. We think Italy is, the elections there are not going to be euro negative. They are likely to be euro neutral. So we have had this level 125.97 as our long-term target. We've approached it. We're nearly there, within so few pips that it really makes no difference. So now we're likely to have a period of consolidation in the dollar, basically saying that we trade between 126. Maybe at some stage we try to push for this trend line around 127, 128, but that is immaterial. We will be trading between 120 to 118, and where the moving average support comes in, and the 126 to maximum 128 area. So that is another period of stability for the next couple of months that we can see, and actually shorting the euro when it gets up towards 126 with a stop loss of no more than 200 pips is not going to be a bad trade. We are quite sure that you will see 120 to 118 at some stage before he makes the next move higher, and probably breaks this trend line and goes towards the 140 level. The dollar, we think, is in terminal decline. It's just a question of the pace of that decline, and we'll now have a look at a chart of the DX. And here we have the weekly DX. As we kept on saying, we just cannot be bearish at the 0.618 of the entire move. We cannot be bearish when we are below the weekly Bollinger Bands. We have a very oversold RSI. We think that a period of stability of several weeks and months, backing and filling back up towards 91.60, 92, or even a little bit higher, is more likely than a immediate continuation of the move down. Let the Bollinger Bands widen, let the market correct the oversold situation, and then we can have the next move down, which should take it back towards 85, and our final targets, which will be back down towards 80. Basically undoing everything. The whole Obama bull market cycle will be undone by Trump, and the market will go back to a period of equilibrium around the 80 area, give or take 5%. But that is what we are aiming for towards the end of the year. In the meantime, a couple of percentage points higher, followed by the move down to 80. As you have guessed, we are looking for stability. We've shown you why, and the spreads show much the same figure, much the same thing for the immediate future. SPY over IEF, which is a very important risk-on, risk-off spread, stuck between the 50 and 200 day. We will be trading in here for quite a while, and at some stage we look for a breakdown towards a more sustainable uptrend line, which should be around here, which should take the S&P down to, I don't know, 2400-ish or so. But in the meantime, we are certainly not looking for a large move in these spreads. There isn't a single spread at the moment, not one, which says that risk off is imminent. So please keep that to the back of your mind in your trading. Do not sell the market in a hole. That is silly. There is no reason to do so. Volatility has abated. All the spreads are in risk-on mode. Basically, we are now in a period of stability, allowing time to cause these moving averages to constrict, and therefore give us the next big trading opportunity, which we don't think is going to be until May or so. Even the indicators which are the most important for the very short term, like SOX, semiconductors over the yen, show exactly the same, stuck between the 50 and the 200 day, hugging the uptrend line, and this we think is going to continue for a while. This is the spread you would have expected to have broken down very hard with this recent yen move, and also with the weakness in the stock market. It has not. Therefore, see how we are just not in imminent danger of a collapse. We just don't see it. We would need to close below the 200 day, below this trend line, and that is another indicator of a period of several weeks of stability before the next move can take place. You will say, well, Nick, you're saying the market is going to be stable within a 5 percentage point range for quite a long time. Is there anything which actually argues the opposite? And the only thing that would argue the opposite would be this chart, which is short-term bills against the 5-year note, if it was doing something extreme. But even that has been doing absolutely nothing since the beginning of the year. It is at the same level, more or less, that it started the year. It is only a few basis points away from it. We would be expecting, if there was some imminent danger, we would be expecting this spread to be trying to break out towards new highs. It is not. It is another sign that we are probably in a period much like here, that we will be trading in a very few basis point range on that spread, and therefore that stability with sharp ups and sharp downs in risk on and risk off is, but within an overall risk on bias, is more likely than anything else. So even this spread, which would be the one which would give you the earliest indication, is not doing so. Until it does, and don't worry, I will inform you if it does. We just don't see it turning for the time being, and therefore we're quite convinced in our stability story. The final chart I want to show you today is emerging markets, and this has been our our most profitable market for a very long time. We are basically now in a fourth wave, which would argue again, even here, for sideways trading, probably violent, probably all the way above 50, and probably retest this trend line around 45 a couple of times. But this is another argument that we are not about to collapse. You can see how we have tested the trend line and we have remained above it. This to us is very significant for emerging markets. This to us argues that emerging markets sooner or later are going to go into probably a final wave higher, just as the S&Ps do not a lot. So emerging markets, everything that we see says that emerging markets is a much better place still to be than the S&P. NQ confirms. So we are looking at anything, we have looked, and we just can't find anything which does not confirm our view that we are basically in a period of several weeks of stability. NQ, we would not be surprised if just below 6,500 held and 7,000 capped for many weeks, and basically we will let time retrace before probably doing a quick move back down below 6,500 or even below 6,000 before we have another move up. This to us is the most bullish of the US markets, the one we have least fear that we will be killed if we buy a decent sized dip. It makes sense both fundamentally and the technical picture coincides. And with that, let's have a look at the biases for this week. We think we pretty much nailed it last week. We're still sellers of rallies in FV and TY, so 5s or 10s. The short end should be more or less anchored. SHY is where people are going to put their money every time they're fearful. Hasn't moved. The rest of the market basically moved down. We are sellers of short-term volatility because we think that the panic is now over. Bunds and bobbles exactly the same as above. We're better sellers on rallies than we are buyers on dips. The SPX, any higher than 2760 probably gives us the 2800-ish gap fills, which would be a good thing from a technical point of view, would open up the downside. 2700 to 2680 should hold for the next couple of weeks, with 2620 being our line in the sand. Any lower than 2620 and we are probably wrong. 2620 held so well last week and there was so much action at it that we now think it's going to be a very important swing level. So remember that one, 2620. But we certainly think that 2700 to 2680 will hold, and on the downside, and 2800-ish on the upside will be about as much as we can do. NQ, we still, this we wrote last week, we still much prefer it to SPX, and we were absolutely right in that one. Volatility closed below the all-important 1950 to 1980, indicating things will not be nowhere near as vicious as the last couple of weeks. As we've shown you, stability for some time, probably a good 2 months before volatility part 2 can be expected. Nothing much changed here. We still think long XLK, short SPY, long EM, as we showed you in that chart, is the trade to hold, and to hold for the medium to long term. Thank you very much indeed, and tweet you tomorrow.